Welcome back to the channel. In this video, I will talk about 5 principles that are beneficial for long-term investors. This video will be the first of many personal finance related videos that I will release on the channel. For those of you who are new, my name is Cash, and on the channel I focus on the markets. I provide my thoughts and insights on the stock market and really try to focus on sharing opportunities to build wealth. Investing isn't easy. There are lots of ups and downs, and in general, nothing is certain. No one knows what the market is going to do tomorrow, 1 month from now, or even a year from now. Often this uncertainty makes people quite emotional in the moment. With that being said, however, there are important rules that long-term investors need to learn and rules that should be followed in order to have success in the markets. Time is your friend. The sooner that you start investing, the better, because of the magic of compounding. The decisions that we make now are the most important because millionaires are made in their 20s and 30s, not in their 50s and 60s. When it comes to investing, the early bird always gets the worm. I know the pandemic has been hard for everyone and some people are struggling financially, but if possible, there's no better time to start investing than right now. Even investing a modest amount will take you very far over the long run. Looking at the chart, this is clearer than ever. Assuming someone invests $5,000 per year, starting at age 25, at an 8% return, they will end up with nearly $1.3 million by 65. However, if someone starts 10 years later at 35, they will only end up with roughly $565,000. This is a huge difference. You start 10 years earlier and you only invest $50,000 more, but you end up with roughly $735,000 more at 65. This is nearly 2.3 times more because you started 10 years earlier. That's a huge difference. Maybe investing $5,000 at first seems tough, but that's roughly $100 per week. If you're just starting out and it's too much right now, start with whatever you can afford to invest and just try to be consistent. It will definitely pay off in the long run. Be optimistic. Over the long term, things are constantly improving. We as humans have proven to be extremely resilient and innovative. From electricity, reaching outer space, to creating and mass producing effective vaccines for COVID-19 faster than anyone thought possible. We really are capable of doing anything. It's always best to be optimistic about the economy, the markets, and investing. Here's a chart of how the economy has performed over the last 170 years in the US. Markets are volatile. You'll suffer drawdowns and likely be down 30 to 40% on some positions at one point or another. Further, when there is broad market volatility, your entire portfolio will draw down. This is completely normal, especially for growth-oriented investors. Volatility can be reduced through proper asset allocation, but cannot be avoided entirely. Having the proper asset allocation is important because it is something that is essential for you to meet your financial goals in life. Retirees have very different needs compared to a 25-year-old who has just started to invest in an RRSP or a TFSA. And to add on, quite regularly, things that have never happened before will happen. You must always be prepared for the unexpected, including sharp downward swings in the markets and the economy, as was the case during COVID-19. Market volatility is something that can be used to your advantage, provided you have a proper asset allocation. You can take your cash or cash equivalents and buy stocks and companies you like at a lower price than you would pay otherwise. This is what I chose to do during the pandemic. It's never fun seeing your portfolio down, but like Baron Rothschild once said, always buy when there's blood in the streets, even if the blood is your own. Lastly, never invest money you need in the short term. Taking on principal risk and investing short-term cash to increase your returns slightly greatly increases the likelihood of permanent loss. Having a short-term time frame can break you financially if there is a sell-off in the market at the precise moment that you need to raise cash for personal liquidity. Relying on selling equities to raise cash to cover personal expenses in the near term is a very risky move and is something that I would always avoid. Thanks for watching, everyone. I hope you guys enjoyed the video. If you did, please feel free to like it, subscribe to the channel, and ring the bell for notifications. And until then, stay safe and we'll see you soon.